Hello, my name is David Ruffin with OptimaFI, formerly IntelliCredit, Credit Risk, and welcome to today's webinar on stress testing entitled Be Proactive and Examiner Ready. The title is chosen with some degree of pertinence because we're seeing some pivot going on relative to regulatory oversight in our industry at this point, largely driven by limited resources by regulators. Everything we're beginning to sense is that there's a shift going on over in terms of the responsibility to be taken by financial institutions to be kind of their own governance, particularly in the risk areas. And while that may have some upside to it, because you can kind of follow your own wits about what you need to do to run a risk minimum shop, we also realize that that does present some other challenges because the behavioral changes are taking place as we speak. I am joined today. Again, I'm David Ruffin, President of Credit Risk Solutions of OptimaFI Credit Risk Division. I'm honored today to be with Steve Huntington, who is Director of Analytics with the balance sheet pillar of our rebranded company. Those of you that may be joining us for the first time and realizing this, since the beginning of the year, we have taken three previously legacy companies and rebranded them into OptimaFI, or basically helping financial institutions realize their more optimal state of performances. These obviously were the legacy companies, Quick Rate. Many remember, been around a long, long time, since the mid 80s. Also Infusion since the mid 2000s, and IntelliCredit was formed in 2019. Those have kind of been morphed into, as I said, three pillars relative to the rebranded company. The Optima FI Growth Division is largely focused on pay for performance robust campaigns to increase deposits and loans. The credit risk pillar, which I represent, is obviously focused on credit risk management areas. And again, sharing the presentation today is Steve Huntington, who is from the balance sheet pillar, working with issues like CECL, the former quick analytic tool that'll come into play, and also the stress testing, particularly from the portfolio level that we'll talk about today. So our agenda today is, of course, to ask us what keeps us from stress testing, what does stress testing mean from a loan and a portfolio perspective in particular, what are the different types of the stress tests that we should look for, and how can we kind of cover, we as bankers, you as bankers, cover your needs and enhance your own effectiveness of picking certain methodologies on stress testing. And of course, being a webinar as we are, we certainly encourage active participation through questions. And please come through the chat area to ask us any questions at any point in time. I would like to remind you that the deck will be shared with all participants shortly after conclusion of today's webinar. At the beginning, just to encourage some audience participation, we would like to ask you a couple or three questions to get started today. One is, have you performed or had a third party perform any credit-related stress test in the past 3 years? Just a binary yes or no. So it looks like about 70 to 76-24 split, that a majority of you have done a credit-related stress test. So we will go to the next question then. So what type of stress test? And again, we'll be peeling the onion a bit on this issue about what type of stress test would it be? Has it been more of a portfolio level, or what some of us call a top down, or a loan level, or otherwise known more or less as a bottom up, or a hybrid of both? No, kind of a mixed bag. A third top down, a third bottom up, and a little over a third a hybrid of both. That's an interesting mix. Last question. Hopefully we have the final. There we go. So this is an opportunity to just comment on your kind of instinct, knee jerk, whatever, on what you consider the benefits of the stress test. Um, does it just satisfy a regulatory suggestion or mandate? Is it a theoretical exercise in your mind? Does it inform you of key risk drivers, i.e., borrowers? Should stress occur, or does it play any key part in your capital planning?
I guess we should have added an all of the above answer there. Come to
That's
think of
true. That
it.
we're thinking just alike, Steve, because I thought this probably would have been better to be a ranking of a multiple choice or what have you. You're right, all of the above.
Forcing everyone to give their top number one answer. That's all right.
Yeah, I'm particularly encouraged by the the third response. To be honest with you, that's one of the concerns I've had, and we'll talk a lot about that in my segment around to get over the theoretical aspect of stress testing. It darn well better be giving you explicit, identifiable borrowers that are the primary risk drivers upon the
Mhm.
realization of theoretical stress. So that's a very encouraging uh, response to me. So, well, thank you very much for participating on that. So, basically, one of the conundrums that we have, of course, in stress testing is what does it look like? I dare say there's hardly anyone on this call that is mandatorily required either through CCAR or DFAST requirement of stress tests that came out of the Dodd-Frank era from the financial crisis. Um, but however, we're hearing certainly from our client base for really the last 3 or 4 years, particularly with the advent of or the increased concern on CRE lending and the concentrations that are forming at the smaller community financial institutions in CRE, that more and more stress testing is being, in effect, mandated even by regulators. But the good news here is that because it's not being prescribed to virtually everyone on this call today, it is somewhat in the eye of the beholder. In other words, if it's documentable, repeatable, rational, backed up by defendable information, then I think again the efficacy of that stress test I think can be defended and should be looked at from that standpoint as kind of a if you will, a food court here of what options you might have to be looking for. There are again all sorts. Being in the credit world myself, we use in effect a stress test at the underwriting. Typically, we used to call it projections. I call that kind of a sensitivity analysis, very much at the loan level. Steve's going to focus a lot on more of the portfolio level, and of course, they both have great attributes. And we're big advocates of not necessarily being limited to one methodology alone. Um, Now, this is where stress testing kind of begun 20 years, 30 years ago in terms of concept. But this is one of the biggest conundrums we still have in the industry right now is that it all starts with data. And we hear this almost endlessly when we're talking with banks about stress testing. And that because their comfort zone in many ways is in that kind of sensitivity realm that I was just alluding to. And that is where are you on collateral values, LTVs, debt service coverages, NOIs, cap rates, and the like. The problem with that is that many times these data points are not real time accurate. They may date back to the inception of a loan 3 or 4 years ago. They aren't current in real time. And it does present one of the greatest problems you have in terms of the efficacy of a stress test. We have a form of that can be looked at. We'll talk about it near the conclusion of today's presentation. That is an option that could be used. But again, one of the things we are going to talk about is how do you get around this issue of the lack of currency or up to dateness, I should say, in these very typical vital data points that many people think of when we think of stress testing. So, Steve, I know this is your part, and I think we'll go through a couple of slides in the deck here
Yeah.
before we turn it over to you live, and I'll let you tell me when to switch the deck on you.
Thank you, David. I appreciate it. Good afternoon, everyone. I apologize for my webcam not being working currently. That was inadvertent, I promise. But we'll work through it. So when it comes to portfolio level automated stress testing, we perform three completely separate and independent tests as part of our stress test. The first test is what we call the peer group loss experience. And that is where we're aggregating your peers, however you want to define your peers, building a custom peer group or using a UBPR peer group or a peer group of like banks, and looking at their how they perform from an asset quality standpoint, from a loss standpoint, in different economic environments historically, and then applying those loss rates, your peers' loss rates, to your portfolio going forward. So you can answer the basic question, if my loan portfolio, the way it's currently structured, if it were to perform over the next couple years like my peers did in healthy environments, in unhealthy environments, and worst case scenario environments, what would be the pro forma impact on my P&L and my capital? So we are completely reprojecting earnings and capital under varying degrees of stress defined by your peers' historical performance at as granular a level as is possible given the call report segmentation that we have available to us. Now, the second test is all the same steps, all the same methodology. However, instead of using our peers' historical experience to inform loss expectations moving forward, we use our own historical experience. So they're very, test one and test two are designed to be completely symmetrical, with the difference being, again, test one is assuming that you're going to perform like your peers, and test two is assuming you're going to perform as bad as you ever have from an asset quality standpoint. And the third test is a little bit different. It's what they call a reverse stress test. And it's what I fondly refer to as the how much rope do we have to hang ourselves with test. They've call it a reverse stress test because it takes the methodology from test one and test two and does it literally in reverse order. Instead of reprojecting loan losses and using that to reproject earnings, and then finally using that to reproject capital, we start at a preset future capital level, say the minimum to be well capitalized or adequately capitalized, or any sort of internal capital trigger. And then we work backwards to figure out what levels of losses could we, in our portfolio, would it take for us to get to that point from where we are today. So it's very much a break the bank at different thresholds type of test. Next slide. And so for both test one and test two, there's three basic steps that the stress test goes through. After we have defined your peers' loss rates or your historical loss rates, step one is about applying those loss rates and making them applicable to your portfolio today. So we take historical peer loss rates, we apply them to your current balances to calculate what levels of actual net charge-offs in dollars and uh, gain or loss on sale of Oreo and reserve levels you would have to meet in order to perform like your peers did in the past. Step two, really, once we've calculated the actual loan losses, a lot of times in some stress testing environments, that's kind of the end point. But for this type of stress testing, it really isn't just about the loan loss number. The benefits of this type of stress testing arise when those outputs, those loan losses, are linked to the income statement and are built through the balance sheet in order to determine the impact on net income and finally on capital. So it's really taking it all the way through to reprojecting capital so that you can take what is just in a vacuum, some sort of a ramped up loan loss number, and make it applicable to your strategic planning process and your capital planning process. Next slide. And so we built our interactive portfolio level credit stress test. And when you run that report using our tool, the entire report is run prior to logging in, meaning that the second you pull it up, you're going to see the results of your stress test on the screen in front of you. And we can do that because we already have all of your historical data as well as your peers' historical data coming directly from the call reports that populate the tool when you first log in. So all you really have to do is go through the assumptions and inputs that we have put in there and customize them to your liking. The other huge advantage to running a stress test in an interactive one in an automated type environment like we have here is that as soon as you make any change in input or assumption, the entire tool recalculates instantaneously on the fly, so you could immediately see the impact of those change of assumptions in the on the end result. And this is something that makes the entire process a lot more efficient and go a lot quicker. I've seen a lot of models where you plug in hundreds of inputs and assumptions and then you click run report and then you wait for this big PDF and you get this 50-page report and then you print it out and then you want to change one thing and you have to go through the entire process over again, run the whole thing again, and then set them side by side and figure out, all right, what change did that actually make, right? But using the way our tool is designed, you can toggle over to the inputs, tweak any individual input or assumption, and then toggle right back to the results and see immediately what impact, if any, that change in input had. That has the other benefit of letting you know what's going to move the needle, right? You could spend tons of time, sharpening the point on each individual assumption or input, only to find out that changing 75% of them made no impact whatsoever on the results, and that it was not time well spent. We're very cognizant of your time and how much time you spend using this type of a tool, and so the way we built it, it makes that much more efficient. I guess with no further ado, David, I should probably go ahead and show them what that looks
Yep.
like.
Yep.
Let me go ahead and
Absolutely.
share my screen here.
I'll stop
Just a
sharing on
moment.
my end.
All right, screen two. There it is. Let me know if it pops up.
Yep.
Excellent. So this is in our, again, logged into OptimaFI to Call Report Insights. With Call Report Insights, by the way, that is our rebranded name for Quick Analytics. So everything that you had as part of Quick Analytics is now part of Call Report Insights, including our automated stress test. So I pulled this up here. Notice when I first log in, I already see an executive summary of the report with baseline scenarios, adverse scenarios, and severely adverse scenarios. Before going over the results here, I'm going to go right to the inputs and we're going to start there. So if I toggle over to the inputs, um, because this is a projection model and we are completely reprojecting your earnings and your capital under these varying degrees of stress, we need to have some idea from you guys on the front end of what you expect to see over the next couple years. Again, we're using a 2-year time horizon. And so by default, we show you, your net interest income, fee income, overhead expense, taxes, net income, et cetera, over the last 2 or 3 years historically, and then your trailing 12 months. And by default, we just use the same run rate that you've had for the last 12 months going forward over the next couple of years. In this case, let's say 207 million in year one and 207 million in year two. You can customize these values to whatever you want. Same thing with your non-interest income and your overhead expense and your tax rate. You can either have your fee income to average assets stay the same at a certain percentage, or you can change the dollars and everything else will sort of recalculate. Once we plugged in some sort of middle of the road financial projections, we can customize a loan portfolio. One thing that's critical is keeping in mind if you have any significant loan balances that have no credit risk. If there is government guaranteed on, let's say, an SBA portfolio, for example. A few years ago, the PPP loans were a big part of this. That's not so much anymore. But any other government guaranteed balances that don't have any credit risk, we want to back out those balances so we're not estimating losses on those balances. So you can customize that. And then we also allow some other assumptions as well. remember our reverse stress test. That's where we're setting a future capital level, minimum to be well or adequately capitalized, and kind of working backwards. But we also allow you to plug in not just regulatory capital minimums, but also any sort of internal target minimums that you have for risk-based capital or leverage ratio, where maybe in your policies with your board, if your capital drops to some level that's preset, that's lower than it is now, but isn't as far as any of the um, uh, regulatory minimums, then you can plug in any sort of minimum that you have, and we can solve for that capital level. After we plugged in those inputs, we go to the peer inputs. Remember, test one, we're analyzing how your peers have performed historically throughout the portfolio. So, first thing you're going to want to do is decide whether you want to use your UBPR peer group or maybe a state-based peer group. This would be all the community banks. If you're familiar with our QCBI, the Quick Analytics Community Bank Index, that is now what we call the PPI, or just Peer Performance Index. And so if I click on this, it's going to pull up all the subject bank we're using today. Our guinea pig is up in Maine, and so this is all the community banks in the state of Maine. Or you can build a completely custom peer group, and that's a pretty intuitive thing to do using our platform. But let's just say for today, I'm just using their UBPR peer group 3. I can see in a baseline scenario, so a recent healthy environment, what levels of losses did my peers see throughout their portfolio? And as you can see here, lots of zeros, as we would expect. Reserve levels currently around 120, 125 of loans. If you want to change the look back period for your baseline scenario, you can click and drag on this, and you can go back in time. You can take the last 8 quarters, the last 12 quarters. And as you see, as I'm dragging the slider here, it's highlighting the look back period, and all these loss rates are recalculating on the fly as I move this slider around. Let me go ahead and so then I can toggle over to the adverse scenario. So in our stress scenarios, we're not defaulting to, a recent healthy environment. We are defaulting to the meat of the last credit cycle, right? And so we default to the years 2009, 10, and 11. For most community banks in most markets around the country, those were the worst 3 years of the last credit cycle, not only for highest levels of net charge-offs, but also highest losses on the sale of Oreo. Because again, that's another picture of piece of the credit loss picture. Not only did we have net charge-offs going on, but we also had valuations on real estate dropping like a rock, and so we had lots of loss on the sale of Oreo, which also impacts capital in an adverse environment. And also reserve levels were highly elevated, most during those 3 years, 2009, 10, and 11. If your peer group, depending on where in the country you build your peer group, you can certainly extend the look back period for the stress scenarios to include 2012, 2013, or go further back. And again, as I'm moving this around, it's recalculating all the loss rates. And you can also determine how punitive you'd like to get. In an adverse scenario, we default to 75th percentile loss rate, as that's some of the guidance that we got from the larger DFAST type stress testing. But you can certainly stress the portfolio more or less. If I can bump it up to 80th percentile, and then every single one of these will become a little bit higher, 80th percentile, or I can back it off to 60th percentile. I can even get more granular, and I can stress certain particular parts, like maybe CRE, more or less than the rest of the portfolio. And I can do that at the segment level. I'm going to go back to 75th. And then finally, the adverse scenario, severely adverse scenario, very aptly blood red color coded there, has all the same assumptions as the adverse scenario, except we are going to be even more punitive. We're going to look at 90th, 80th, or 90th percentile loss rates during the worst 3 or 4 years that we have on record. So an extremely punitive worst case type scenario. Now, once we have determined all of the peers assumptions, the last inputs to assumptions are to consider are our own. So we want to define our own baseline scenario, which typically will be the same, most recent 4 quarters or 8 quarters, where as long as you've had relatively manageable losses in your portfolio over the last couple of years, that's a fine place to start. And in the stress scenarios, again, we default to 2009, 10, and 11 as a stress period so that your stress period will match your peer groups. However, if you experience losses kind of before or after, earlier or later than your peers did, you can customize the stress period for your own bank, or you can completely override those stress loss rates and make them manually more or less punitive on your own. So that's all the inputs. And so as soon as I'm done with all those, I toggle right over to the results. And before we go through the executive summary here, I'm going to go through the detailed results. So looking at test one, and I click on detail. Remember when we were talking about this type of a test, we had three different steps, right? The first step was to take your peers' loss rates and make it applicable to your portfolio today. So that's what we doing. That's what we're doing here in the first tab. Here we have lots of zeros. Again, during a baseline scenario, healthy environment, the peer group is not seeing much in the way of losses except for credit card loans and some other consumer loans. And gain or loss on sale of Oreo is negligible currently, and reserve levels are around 120. So that sounds about right. And so we're going to take those loss rates, apply them to your portfolio today, your balances today in each segment, and calculate actual net charge-offs that you might see on an annual basis going forward if your today's portfolio performed like your peers' loss rates. Adverse and severely adverse scenarios, obviously the loss rates are ramping up significantly to 1 to 2 to 3% net charge-offs per year going forward. Gain or loss on sale of Oreo is starting to become more significant now, with 10 basis point loss and a 26 basis point loss for this particular peer group. And reserve levels. If we're assuming that you're performing like your peers did, we're going to assume your losses were like theirs, your Oreo was like theirs, and your reserve levels had to get up to theirs. That's that double whammy, right? During a deteriorating credit environment, not only do you have escalating that charge off to deal with, but you're also being told at the same time that you need to not only provide on your income statement for those escalating charge offs so that your reserve doesn't drop. You're being expected to bring your reserve up to a higher level. So your provision for loan losses on the income statement is taking that sort of double whammy. Now that we have calculated actual net charge offs and reserve levels at your bank, we can take the next step. We use that information to rebuild your projected income statement around these three potential realities, these three scenarios. Again, it's a 2-year time horizon, so we're calculating year one and year two. We start by calculating your core operating earnings, which is what we call the pre-tax, pre-credit, or pre-provision recurring income. This data is coming mostly from your inputs, with slight adjustments here to reflect that if you have less earning assets because of higher non-performing assets in a punitive scenario, then it's going to affect your margins, it's going to affect your net interest income and everything else. But now the big part here is reprojecting your loan loss provisions under varying degrees of stress. So when you think about the loan loss provision, I was sort of alluding to this just a second ago. There's how much provision you need to cover the actual net charge-offs that you're experiencing, so that your reserve doesn't drop, right? So this needs to match the actual net charge-offs that we see, which it does from the previous tab. And then secondly, on top of that, how much more do I need to provide on top of the actual losses, if I need to get my reserve up to a higher level going forward than it is today? So we see the escalating reserve levels and escalating charge-off levels, resulting in significant escalations in provisions as the scenarios get more punitive. Then we have gain or loss on Oreo, which is again negligible baseline and starts becoming more significant as the scenarios get more punitive. And finally, pre-tax income, we tax it or give an income tax benefit if you have a pre-tax loss. And we are resulting in some earnings still in a baseline scenario, some somewhat manageable losses in an adverse scenario, and some very significant losses in a severely adverse scenario. These tests are designed not the goal here is not to have positive net income in even the most adverse scenario. It's to have a capital above, minimum adequate capitalization at 1 or 2 years out. So once we've done this and we've gotten to our pro forma reprojected net income, the last piece of the puzzle is to apply that to capital. So we take all your current capital levels and ratios. This institution is still filling out all the risk-based capital information. If you are elected the CBLR framework, then we'll be focusing on your leverage ratio, obviously, and not total risk-based capital. But we take that and we overlay your earnings or losses and dividends or lack of dividends if you're losing money hand over fist, because certainly they would be suspended under these scenarios, and reproject your capital levels and capital ratios in all three levels, in all three scenarios side by side. And that's really the ending point. That's where we were trying to get to. So if I head back to the summary here, everything I just went over pretty much on one piece of paper, right? We have loan losses escalating as the scenarios get more punitive, resulting net income dropping down and becoming quickly negative, and then current and future projected capital levels under the different degrees of stress. And then we simply chart those and compare them to well capitalized and adequately capitalized minimums. That's the methodology. Test two is, again, all the same steps, all the same methodology. The only difference is that we're using your historical loss rates here, right, as our guide, and then applying your current balances to your own historical loss rates, filling it, sending it through the earnings impact, and finally capital impact. And then finally, that third test, the reverse stress test, again, that's where we're saying, you know, the minimum to be well capitalized. And the fun part about that, as we all know, is there are four minimums to be well capitalized, whether we're looking at tier one leverage, CET1, total tier one, or total capital. And you need to meet all four of these minimums to be considered well capitalized. So we have a kind of an iterative process here, a goal seek, where we have to calculate which of these you drop below first if you were going to start losing money hand over fist. And the answer for this bank is that, well, they'll drop below 10% total risk-based capital before any of the others. So now we're solving for that. What kind of losses would it take in order to drop to 10% for 2 years in the future from where we are today? And the answer for this bank, they're a pretty big bank with pretty good capital. They would need to lose over $400 million in net charge-offs and OREO losses over the next 2 years total, or 8.88% of their loan portfolio would need to go the way of a dodo over the next 48 months 24 months, in order for them to no longer be well capitalized. Obviously, the number is even more outlandish if we're considering adequately capitalized to be the goal, and then in the worst of all worst case scenarios, the critically undercapitalized level. So those are the three tests that we run as part of the interactive stress test. Again, you come in here, you change any input, you can toggle right back. The entire model recalculates instantaneously, making it a very efficient process. Once you've got everything in here, you can save your inputs as a scenario. You can export parts of it or the whole thing to a PDF or Excel. We have a great visual user guide here and a methodology guide. And so it's again, a very well built portfolio level stress test. And I believe at this point, I'm going to hand the presentation back over to David. Hold on a second.
Right.
Stop share.
Yeah. Thank you, Steve.
Thank you.
All right. So we are in the heading to the finish line here. Hopefully you can see the what we are going to certainly talk about. Of course, let me get beyond these. Sorry about
Yeah,
that.
we've led some. I have some screenshots of the
There we
portfolio
go.
stress test there for
We,
you guys to
we,
take home with your slide deck. So you didn't just have to see it live; you can print it out. But yeah.
yeah, we're going to pivot to the home stretch to talk about. Obviously, what Steve talked about was a portfolio level stress test. We're looking at the other primary option in the big divide between the two methodologies, which is, of course, loan level stress testing. We have two options that we can talk about here. In a diagram form, I think it conceptualizes the fundamental difference between a loan level and a portfolio level. The top down or portfolio level is dependent on public data, call report data, The big difference with loan level or bottom up analysis or stress, obviously, is the what I often say on broadcasts like this, the idiosyncratic non-public data that's embedded in your loan portfolio, which is not public data. Obviously, it's unique to you, it's your DNA. Frankly, it has become a an area where a lot of the regulators have put a lot of focus on in the last few years in terms of not only just saying to companion it perhaps with a portfolio level, but certainly to have some form of a loan level stress test in your arsenal as well. One of the things that you heard me say earlier on that one of the conundrums we deal with in stress testing is the up-to-date accuracy of certain data points that many of us think of almost intuitively as part of stress testing, like NOIs, LTVs, debt service coverages, cap rates, things of that nature. One of the things that we have at OptimaFI Credit Risk have made a concerted effort to overcome that conundrum is to try to pick proxies that have legitimacy statistically. And I mean by that in this case, for our law. And the other big challenge we have, frankly, is Steve's got a do-it-yourself tool that has been tested and acclaimed over the many years. We're heading that way, but at this point, our loan level stress test is uh, the two options we offer at this point are as a service, not as a product, but clearly we are aspiring to develop it as a do-it-yourself product as well. But we're just not at that level of making that offering. But one of the so-called proxy methodologies we use, which really comes out of the Basel environment of 30 years ago, is of course probabilities of default, loss given default methodologies. They are legitimate, I think, proxies over a couple of areas. And we'll talk about how we use or go about our loan level stress test in that. First of the thing that we do is we do solicit, we get your information, which is very, very easily obtained. It's really an extract of your loan flat file data from your core system. We ensure that we understand the mapping um, protocols that you use, your risk rate schemes. We get your loans that have been specially reserved for. We used to call that impairment under the old ALLL methodology. It's now really deemed another title under CECL. It's loans especially reserved for. We need that list. We work with you to segment your portfolio in what we call risk cohorts because these risk cohorts of your loan portfolio are roughly three primary areas of commercial purpose lending, construction lending, commercial, and which is more C&I and commercial real estate. Then we have two more consumer focused, which are residential real estate or mortgage loans, as you might think of them, or other consumer loans. They're further segmented, as I said, we have a pool structure where we model through pool analysis, and then we explicitly exclude those that have already been acknowledged by your bank as needing explicit reserves attached to them. The math on it is not complicated. It's really just, again, Basel inspired from years ago. Probability of default, time loss given default gives you your loss rate. We assign that probability default and a loss given default to every loan in the portfolio, but we do it again with the understanding of your loss history as well as cohorts that we will collaborate with you in terms of identifying. And then we segment that into a baseline loss, an adverse loss, and a severely adverse loss, similarly to what Steve alluded to. We then have the option of taking that into the capital impact. Explicitly, what we mean by making sure this has relevance to your particular bank is we do look back for 15 years, which obviously that takes you back to the cusp of the financial crisis, and see where the loss histories are within your segmentation of call report data to indicate pockets or trends that have historically attached to performance within your bank's loan portfolios. And again, all of these are somewhat unique to each bank, and a lot of that's reflective of the market you're in and or the conservative or liberal nature of the way you were underwriting or servicing your loans. But we create these risk cohorts again in such a way that gives you the ability to have input on them. For example, these we mentioned the five basic risk cohorts that we would default to. But in almost every case, we work with banks where they may have unique concentrations of other services. For example, which two examples come to mind. A bank in the Southwest had a very large equipment lending financing in part of their portfolio. So we took equipment loans out of the C&I loan bucket, created its own risk cohort. Another bank has had a huge swath of cash value secured life insurance uh, lending going on as a unique kind of service. We've because of the nature and the balances of those loans, we're able to take those also and segment them out as a separate risk cohort. And then we treat the consumer purpose loans because, and again, one of the key issues here for our cohorts is risk grade, probability default, loss given default, and much of it is driven by the where it sits in the risk grade scheme of the bank. Again, using a proxy such as a risk grade, as in many ways a risk grade should be, assuming that it's reasonably accurate. It should be a very strong proxy for not only original underwriting, but current servicing and current status, financial status, or repayment capacity of the borrower. So we have to use that proxy, and I think that again is as good as it gets, presuming the accuracy of the risk rate. Consumer purpose loans in most banks, while if they were risk rated at inception, are rarely risk rated on an interim basis. We therefore emulate what is comes with the UCC, Uniform Commercial Code, in terms of federally mandated risk assignment of consumer purpose loans, which is driven exclusively by delinquency. So basically, we use proxy risk grades based on levels of delinquency past due and the performance thereof. Again, we will in turn provide through the formula pools all the way down to the individual call report categories in terms of where both baseline adverse and severely adverse loans are over and estimated, and this is over a year's time. Um, so again, we also take it through the capital impact, not dissimilarly to how we do it with Steve alluding to it. I might go back and say that where a legitimate question would be, where did you get your PDs? Where do you get your loss given default or LGDs? I'll start with loss given default. We actually utilize the incredibly robust amount of information that's in uh, Balance Sheet Insights or formerly Quick Analytics that has 30 years virtually of loss history, um, particularly with focus on community banks over all of the uh, loan type categories. So that's really irrefutable data that you can go back in and create um, credible, statistically valid loss given defaults in that. Probabilities of default, uh, not unlike every stress test or credit mark methodology that uses probabilities of default, it's somewhat at some level, somewhat akin to kind of corporate bond rates, but we take it further into that by again examining your bank's history on how you perform in the various loan risk cohorts and make adjustments in that regard. So again, it's a combination of what we feel like our experience has been in that area, but also with input from your bank. So again, what you get in terms of the service at this point, again, please understand we're aspiring to make this not dissimilar to what Steve showed us as more of a product that you do it yourself. Is that we certainly give you a robust board level management report. We walk you through that aspect of it. Um, we give you that amount of information. The one option that we can offer that goes back to those more discrete rate data points that I said had become the conundrum of stress test, and that was how current information was, it like the loan to value or debt service coverages, because they're all over the lot in terms of when they were calculated, is that we have and do offer in some cases, but it needs to be companioned with a loan review where we actually task our loan reviewers to recalculate in real time what are what is the NOI, what is the debt service coverage ratio, what is the LTVs, and again, in our mind, when we here we go again talk about proxies, we certainly think like loan to value are legitimate proxies for cap rates and market trends, and we certainly think debt service coverages, once calculated in real time by our loan reviewers, are legitimate proxies for interest rates and NOIs. And obviously, the primary driver, as I just alluded to, is the risk grade accuracy in terms of being a proxy for original underwriting as well as post-booking servicing and the current financial status of the borrower. Um, so again, we have both of those methodologies that are available, but at this point they are as service. Again, while I was delighted over the poll results earlier in the presentation showing that I think 58% of the participants in this webinar have said that they are getting, uh, irrespective of the theoretical exercise that you're going through with stress testing, which is indeed what it is. It's just a theoretical exercise saying how much can we endure this amount of stress against our credit portfolio. But the most important thing, in my opinion, and it takes it out of the realm of being theoretical and becomes very practical, is that any stress test methodology you use, in my opinion, has to have at its end result the ability to point to a top 25, a top 50, a top 10 number explicitly identifying borrowers that, upon the realization of the credit stress, would give you the most pain, which obviously would mean and beg the question, are these credits being looked at in terms of annual reviews on a current basis? Are we absolutely sure that they represent accurate risk grades? Are they being looked at independently, routinely by our loan review, whether that's in-house loan review or through a third party? Uh, but this is the hygiene that you need to exercise from a very practical standpoint, even up against arguably a theoretical process of stress under duress, or a credit portfolio under duress. So again, what should you do? I think again, pick and choose where you feel like you can do. We are big advocates that portfolio level and loan level stress tests are good complements to each other. Obviously, you're not going to get the peer compare uh, results you get that Steve alluded to with the loan level, because there's no data out there to do that at that level, because remember, that's non-public data. But you also perhaps are not and won't get from a loan level, of a portfolio level stress test, quite the granularity at the loan level risk that you may need to be able to analyze. So we kind of take the position that it is in the eye of the beholder. It's what you need as informed risk managers, credit people, finance people in your bank should be able to know kind of what the values are from the various tests. I keep harping on this, however, because so many people instinctively go to that. Well, what are you doing to stress key data points such as interest rates? You can create your own circumstances where you isolate representative areas of your portfolio, and then what I call through sensitivity stress, apply various stress components to that. But again, remember, if that data is not current and it is not uniformly up to date, you are going to have somewhat of a flawed result in that regard. So again, I don't see any questions in the chat that have come in. I've been monitoring that. We do appreciate the opportunity to make this presentation for you. We know that you have a number of options out there in the industry to do it. Again, remember, I am a strong believer that we are in a pivoting moment in terms of regulatory oversight. I think it would be a grave mistake for banks to think, well, because we're not getting examined quite as often, or the resources aren't as robust out there to be visiting us that often, everything we're hearing out there is that really the burden is now being shifted onto individual financial institutions to run their own risk assessments in a way that has integrity and can be defended. Uh, in a lot of ways, I think that's actually a very big positive because I think sometimes people have gotten into ruts of depending on very thorough and heavy-handed regulatory exams to be in effect a de facto report card on the quality of the way they're managing their risk. Most of you have intuitive senses of how to manage your own risk. You know how to run a good, healthy bank. This is your opportunity to do that. But I think the worst thing you can do is say, well, we won't be regulated as often, perhaps, or visited as often. Therefore, let's not, engage in these kind of basic health, hygiene, risk management tools. So again, we like to, Steve, I'll let you walk through anything you'd like to talk to about the
Yeah,
call
David, I
report
saw
insights.
something come through in the chat. If you want to,
Yeah, sure.
if you want to go ahead and discuss that for a second.
Yeah. How do you incorporate the balance sheet and income statement forecasting the loan level? It is basically it is not as robust in that regard, but it certainly is taking that into account. We take um, kind of normative data. It's not at this point is not as flexible in terms of changing iterations, but it is not totally dissimilar to what Steve acknowledged in the portfolio level.
Yeah, I would say it's the same methodology, just a little bit less flexibility, right? We're still rebuilding
That's
the
right.
income statement
Yes,
around varying levels of loan losses or net charge-offs, and the net charge-offs obviously are reflected in the provision line item of the income statement, and then once you have pro forma income, it flows through capital in the same way as it does really on the portfolio level stress test.
it does, and I will hasten to say this because credibility is to me is more important than almost buying something from me is the reality is that sometimes banks are of the size and complexity that they have separate capital stress, right? That is done exclusive of just a credit stress test. And in that sense, you may be doing that with regard to literally every line item in your income statement or balance sheet
Mhm.
is subject to an optional, variable input. Ours is a little more streamlined on presuming other cost or items remain constant.
Yeah,
Is that
certainly. I mean, everything to some extent in an Armageddon kind of economic environment, everything on your income statement is going to be impacted by that environment, right? Your overhead expense because of
that's
additional
right.
consultants and workouts, and everything will be a little different. But we have to kind of focus on the inputs, the things that are really most directly impacted by the escalating net charge-offs, and do that. Yeah. Um,
Exactly.
yeah, and so I know we're just about out of time here, but so to head the automated portfolio level stress test is part of a subscription package to Call Report Insights. Again, the formerly Quick Analytics, which includes not only the stress testing but also a complete solution to CECL using a warm-based CECL methodology, liquidity reports, interactive bank and peer financial analyses. In addition to call report data, we have public data on larger publicly traded institutions and holding company level data, credit union data. We have a fully built out merger and acquisition database as well. So there's a lot of tools in that toolbox that we call report insights, and one of them obviously is the credit stress test.
So again, just multiple sources of information, and I think you've touched on much of these already. So,
Hmm. Yeah.
and as far as the Optima FI credit risk pillar, we again obviously would be honored to be in your third-party loan review RFPQ, if that's still appropriate for 2026. We also have a number of clients that do loan review totally in-house independently. They subscribe to our application to do that and perform that independent of us. Then there are others that use us kind of as a hybrid of that. As part, we just help, in effect, validate certain portions of their annual loan review. We do, as I said, we are aspiring very hard to make sure that the loan level stress test that we alluded to today is not just offered as a service, but also as a product. But
Mhm.
that isn't quite ready for prime time at this point, but we're certainly heading in that direction. Um, Again, one of the things that you have to hopefully see that we do offer is that there's not an LOS aspect of what we have to do in conversion. You're talking literally 24 hours. You can be up and running in kind of analytics because we're just looking at an extract from your core. We map it to make sure there's uh, integrity in terms of your unique coding, risk rating, and schemes and whatnot, and you're up and running. There's no, painful 3 month, 4 month kind of conversion that you often have to face when you're dealing with LOS based systems, including, frankly, stress testing. So again, I know we always enjoy the webinars. We enjoy the coffee talks. Steve, of course, has probably, along with Sean O'Brien, created Coffee Talk. I ought to patent the name because you've done it
Drank a
so
lot of
often.
coffee over the last few years, David.
So, and I know in that sense, I think you've got something coming up fairly soon. So,
Yes, yeah. Next month they'll be doing a. This is it's in the same vein as our Coffee Talk series, but instead of focusing specifically on our Cecil solver for the Coffee Talk, this is focusing on more of a master class on call report insights, the platform as a whole, and all the different ways that you can use it to inform your board, to benchmark against peers, and to make your job and life a little bit easier.
and I apologize. We let this slip through. Apparently, the date. What's the date of that? Because it's obviously March 18th is today at this current time
Yeah,
frame. So,
I believe it's definitely not today. I believe it is April 16th. April 16th.
okay, April 16th. Okay,
Yes.
we apologize for the typo there, but anyway, again, we constantly aspire to continue to improve our offerings to you, and we appreciate the attendance. We value these abilities to share information, and we certainly consider the most important driver of the development of our deliverables our client base. No question whatsoever about that. So
Yes.
again, this will be shared with you. We do appreciate the opportunity to do this, and please reach out at even subsequent to this with any further questions you might have.
Thank you very much.
Thank you so much.